After intense negotiations in Brussels, Ireland's fate was agreed.
Providing a loan to Ireland is warranted to safeguard financial stability in the euro area and in the European Union as a whole.
Ahead of the deal, 50,000 people took to the streets of Dublin to vent their anger that they and not bondholders will pay, and their concern that the costs are simply not worth it. The overall size of the bailout was no surprise. 85 billion euros, designed in part to boost capital levels at Ireland's banks. The IMF and EU, including loans from Britain, Sweden and Denmark, will make up the majority. Ireland's pension fund and cash reserves will chip in the rest. The loan facility will carry an average interest rate of 5.8%, below market rates, but above what Greece pays for its bailout in May. Last night, Prime Minister Brian Cowen tried to sell the deal to the Irish people.
On other options, I don't believe there are any other realistic options. For example, in relation to the question of leaving the euro, that is not an option for this country.
The Irish now face 4 years of unprecedented austerity and possibly more repaying the IMF EU bailout with interest. It's prompted many in this country to consider whether a debt default might in fact be less painful. The chief economist of KBC Bank in Ireland says there's no need.
It will struggle for the next while, but we are seeing very strong performance by exports, tentative signs that maybe unemployment has peaked. So the economy is very flexible. There is a chance that we will get out of this reasonably well, but it is going to be a very tough and uncertain time, at least for the next year.
With Ireland rescued, the EU says Portugal and Spain need to do more. The Spanish Prime Minister, who met with business leaders this weekend, agrees.
We're going to accelerate reforms as much as we can.
But as the Irish can testify, once the markets have you in their sights, dodging a bailout can become a losing battle.